Happy Wednesday. Welcome back to another week of the Educated Homebuyer with Josh and myself, here to update you on the economy, interest rates, the impact of job cuts on the housing market, all of that good stuff. Josh, how are you this evening? Your lighting looks good over there.
Well, we're trying. We're trying. I did what you said, and I turned the main light off. I don't know if I like it, but we'll see. We'll see what the guests say. They may say
Yeah, let
it's
us
awful.
let us know in the comments if you like Josh's lighting, or do you prefer for him to look like he's standing on the sun and baking
They
as we.
like me well lit.
There you go. So, Josh, rates from last week kind of back into better territory, which we're going to talk about a little bit here. But we're a couple minutes early on the show tonight, just to come on early. And so, with that, thought I'd give people a little bit of time here to hop on. So, anything you want to add before we jump into some slides?
No, but tomorrow is Thursday. It's Thursday. We get the weekly jobless claims. It will be interesting to see when some of these job cuts start hitting in the weekly claims. In the grand scheme of things, the numbers are fairly minimal. When you talk about a nation of 300 something million people, we're not talking even a million people being out of work anytime in the near future. So we'll see. We'll see what it looks like.
All right. With that, guys, let's just dive into the charts and get into the reason that you're here. While we're doing this, let us know where you're watching from. Start putting your questions in the chat if you have them. That way we can just flow right out and get to business once we're done looking at this. So, as we always like to do, let's start with inventory. This week, we saw a little bit of an uptick, sitting at 638,000 single-family homes that are unsold on the market right now. After 2 down weeks of inventory, we're up almost 1% from a week ago, which is a positive sign. 29% more homes on the market than the same week last year. So inventory is trending in the right direction, and could lead to better things out there if you are a home buyer. So with that said, as I mentioned a moment ago, we jumped up from 632,000 to 637, almost 638,000. Again, that peak last year, 739,000. That's kind of what we're watching for at this moment, at this time, and we're likely to surpass that at some point this year. But again, if we're looking back to 2015, same time, we were sitting in the mid 900s when it comes to inventory. So we're still quite a ways from there. Orange County listings up 4.12%. Week over week, sitting just over 3,082 homes. Huntington Beach up 7.79% week over week, sitting at 231. The last time we saw numbers like this was mid-November for both Orange County and Huntington Beach. So if you're here local, starting to see more inventory earlier in the year, which means we're probably going to pass those numbers that we've seen over the last couple of years. Now, Josh, this is the Washington, D.C. market. So if you're out there, if you're on X, if you're reading Wall Street Journal, any of those major publications or journalists or what have you, the big news is that people are getting laid off, and they're getting laid off in DC, and that's causing this just pile of homes to come to the market. And as you can see from this chart here, inventory hasn't really done much. Now, again, is it something that we're just not seeing it quite yet because it's so new that people haven't decided what they're going to do? Hard to say. But if we go into this new listings chart, which is, again, the same market of, actually, did I put it in the wrong spot? Let me see if I can find it. There you go, DC Metro. So this is new listings coming on the market. You can still see we're still below where we've been the last couple of years. So we haven't seen that spike in new listings quite yet, but this is the chart that you would see it on if we start to see that.
Jeb, here's the funny part. So granted, we're 2.5 weeks into this whole entire process. So first of all, I don't know anyone who a life event happens. Hey, I lost my job. Hey, Jeb, will you come out and put a sign in my yard? I got to sell this house. And if you go back a month, the working theory was that all of these people have been able to work from home. So they're out in Maryland, they're out in Virginia, and they don't have to worry about coming in, or if they come in once a week, they can drive in a couple hours. And the theory was they're all going to move back into DC, and we're going to see reinvestment and more people buying in DC. So now we've gone from that to the market's going to crater, and we're way too early for the data to tell us anything, despite what Alex Jones wants to tell you in one of his Twitter rants.
There you go. So we like to look at new listings because, again, that's a good indication of where inventory is headed, kind of a forward-looking indicator, if you will. 57,000 new listings unsold for single-family homes, another 11,000 that were immediate sales. So total this past week, 68,000 homes. That's 8% more sellers than the same week a year ago. Again, positive things for buyers out there. We looked at that chart a moment ago. Home prices up just 2% versus last year. So home price appreciation was about 4% all the way to the end of 2024, looking now somewhere around 2 to 3% nationwide. So it's down a little bit, but again, still positive. And a lot of it is going to have to do with what happens with interest rates and the overall market going forward. But you're not likely to see any declines soon. But if we stay where we are, you could see some flattening in that.
A wise man once said median prices are dumb.
Well, that man is correct. So home sales, this week's newly pending home sales came in at 60,000. That's an increase of 5% for the week, and 304,000 homes with contracts pending, 3% fewer than a year ago. So Q1 2025 home sales are going to finish actually lower than where they did in 2024, assuming the trend continues from where we are at the moment. And then price cuts, we always look at this. 33% of the homes on the market have taken a price cut from the original list price. It's down a tick from last week, but still elevated, as you can see from this chart. So with that, Josh, foreclosures. We actually recorded an episode on the Educated Homebuyer podcast today. It'll be released in 2 weeks, discussing foreclosures in great detail. I mean, really a lot of detail on it. So if you're thinking foreclosures are coming, wanting to buy a foreclosure, it's a good episode for you. But Josh, what are we looking at here?
Well, generally people, Jeb, are not at home thinking there's foreclosures coming. They're hoping or praying, or they need them to be. There's a certain cult of people out there who know it's coming, and it's just, you just got to wait. Just hold your breath. It just shows you the slope of that line from what is this, about 2009 was the worst of it when we had the most foreclosures. And then from about 2016, it's leveled off, but still decreasing. That trend is clearly down from that perspective. That blip from 2020 to 2022-ish was the moratoriums and forbearance and all that fun stuff. So throw that out. That line basically goes straight through if it weren't for those time frames. This one, Jeb, is another thing that popped up in the data that we were looking at and preparing for that today. Interestingly, this shows the percent of loan balances 90 plus days delinquent by loan type. And strangely, somewhere in 2020, no one was delinquent on their student loans anymore. We got everyone brought current and they're all good. I guess that's because if you don't have to make payments, then you don't get behind on them. Credit cards are up. Autos are up. Mortgages and home equity lines of credit, things that are secured by an asset that you really can't afford to lose if you have any choice in the matter, basically very, very level there. I forget the report that it came out of. Let me actually look at this.
It came from, it was also in...
Well, it's in calculated risk, but
yeah.
They were quoting an actual, this is government. The government puts out a quarterly report on household debt and credit. So this is from the New York Fed, the Center for Microeconomic Data. So there's a bunch of good charts in here. We're going to buzz through them real quick. Current quarterly transition rates for current mortgage accounts. So from 30 to 60 days late, you see that dip down. They had been going up, but 90 days late, we're not seeing people transitioning into 90 days late. We've seen a few more 30 and 60 days late, but no one or very few people are transitioning all the way to that 90-day, which is considered seriously delinquent, where they're at risk of losing their home. This one here, Jeb, I think I got this out of order, but it's still a good chart. Malden threw this in his weekly charts that matter. And looking at this, he's saying that history doesn't always repeat. But if you look in the late 60s, early 70s, we had this wave of inflation that receded, came back with a vengeance here in the late 70s, receded, and then had a third wave of it again in the early 80s. So for those of you out there who think inflation is coming back, we haven't whooped it. It's been kind of persistent at that high twos, low threes, depending on which measure you look at. And there's a few things that, I don't know, the PERMA bears still think is a little bit negative there. Back to that household debt and credit. Wanted to show you guys this because, again, overall loan volume, and good Lord, we go back to 2021, there was $1.3 trillion of loans done in 1 year, and we're going to be at about 500 billion this year. But when you look at that, the vast majority of them are the people with credit score of 760 and above. If we throw in, that 660 and above, it's almost everyone. Very few people in that 620 to 659 cohort or under 620 are going to be getting loans in the current market. So credit scored origination, what this is showing you here is 50% or more of borrowers are at like 770 or above on their credit score. 25 or 75% of them are at 710 or above, and 90% are at about 650. Jeb has done videos on USDA, FHA, VA. They don't have a minimum credit requirement of 580. In the real world, very, very, very few people with credit scores under, say, 620 are getting mortgages because the terms, even if you can qualify, are very bad. So you're paying a big premium for that loan. And on top of that, it's harder to qualify. You're not getting an automated approval in most of those situations. You're having to jump through some additional hoops. This shows you the breakdown of total debt of what it looks like. The orange is mortgages. Probably not surprising to everyone that is the vast majority of debt. Student loan is kind of shocking that it's up there as big as auto loans. Credit cards, much smaller than either one of them. Debt share by product type and age. So again, orange here is mortgages. You can see 18 to 29-year-olds don't have a lot of mortgages, but from 30 on, that is far and away the biggest debt that anyone has, which is why we're here and why we're trying to guide and advise you on how to take on that debt and maximize its positive impact on your financial life. This Jeb here is a cool chart, breakdown of mortgage originations by age. And we can look right now, this is about what you would expect. 30 to 39 is the biggest group, 40 to 49 is the next biggest, and then 50 to 59. That meshes up really well. If you look at the demographics on Jeb's channel, on what we have here for this channel, the podcast channel, that is the wheelhouse. It's about, early 30s to late 50s. There's a few borrowers on either side of that, but that is the majority of home buying age. Thought this one here was interesting, Jeb. Total debt balance per capita by state. So us Californians here are the winners. $90,000 of debt per Californian. But if we look at this next chart, it goes a long way. This says that composition of that debt in California: more expensive homes, bigger mortgages. The rest of the debt is in line, and if not even less than the rest of the country, but we just have bigger mortgages. This chart, Jeb, we get to hear from people regularly. This is what rates are at their long-term average. This is just what rates are going to be. There's some truth to that. This is Treasury yields. You can't really see the little text there. It tells you what was going on and what the historical context was. But if we plot that out back to 1790, 10-year treasuries are basically right at that long-term average. If you take out the blip here, above 8%, we had about 2 or 3 years. You take that out, it's going to bring it down. So I think we're above what is average, but if you include all that, it definitely supports that. This is the change in the 10-year yield after the first Fed rate cut. Jeb, we had talked about this, that if you look here in the first 25, 30 days, it is not uncommon after Fed cuts to see rates rise. And that's any of those time periods there that are just above the gray line. But what is really weird or unexpected or rare is since 1989, they have all, after 80 days, rates have improved. We're now 120, 130 days on from that first cut, and we're 100 basis points high. So something is either going to break and go the other way, or we have set a new precedent here of where we're at. You had mentioned, Jeb, what did rates do over the last week? So the little green box is the last 5 days. We had CPI last week, came out hot. The market didn't like it. That green chart, green is not good in this situation in 10-year yields. The next day, PPI came out. The market liked that a lot better. We improved. And then, Jeb, what did we get on Friday? There was a weak retail sales, and it almost pushed us back inside that range the last 2 days. So markets closed Monday for President's Day, Tuesday and Wednesday, kind of back to where we started the day Friday. This is sort of visual representation of what's happened since we were here last. We had peaked on the 10-year up at about 465, got as low as 446 last Friday after that week retail sales, and then we're at about 454, kind of in the middle of that range. So better than where we were last week, but back to where we were last Tuesday. If you look at this, all of these basically show flat week over week, not a whole heck of a lot of change. But if any, it's slightly better than where we were a week ago.
All right. And for those of you out there that have a higher rate than you like, you're looking to refinance at some point in the future, if you go to jebsmith.net/rate watch, one word, you can get on the list and we will update you as mortgage rates come down. So there's a couple questions that I'll ask you, or a couple questions rather, and let us know what rate, actually makes sense. And then we can reach out on your behalf. And then lastly, if you're in the process of doing something at the moment and you're looking for a second opinion, looking for help, guidance, you're starting the process, jebsmith.net/start will get you in touch with us here, the team, and get you going in the right direction. So with that, Josh, this past week's podcast episode, we stopped mentioning the podcast on here. I don't know why, but
because we got a little further in advance, so it's harder to remember what is available to them to watch right now.
Yeah, so this past week's episode is 5 questions you should be asking yourself if you're a home buyer. So if you haven't listened to it, it's important. It's a deep dive, a 30-minute, 25-minute conversation about that, what you need to be considering in this environment. This environment's different than the last couple of years. So take that into account. Head over to the Educated Homebuyer podcast channel, listen to it, let us know your thoughts, and let us know if there's anything else we can cover on that you'd be interested in. So, Mr. Josh, Barbie is saying thank you.
She's very welcome. I was actually going to have to call her after this, but since she's watching, I will let her know right now that I appreciate her follow-up on her email. There was one other thing I was supposed to do that I didn't do, and she shot an email, and we got it taken care of.
Very well. So good stuff. We got Maddie, who is a regular in here as well. Thank you for joining us this evening. And then we got Josh. Josh, you're making comments here on another account?
I just saw my name and I'm like, why am I asking questions about real estate? I'm like, oh, it's not this Josh. It's that Josh.
Well, we're just going to dive into it. The goal here with the channel, with this live every week, is to answer questions, right? That's how this whole thing originated to start with. It was all about question and answer. In fact, I have a question after we ask this question. So I've seen homes greater than 45 days on the market. What's the chances they would take a contingency of selling my home in order to buy theirs? Mine would sell faster based on comp. So I'll take that question, Josh. I think that's reasonable. A home's been on the market 45 days. If I were the listing agent and it was a reasonable offer and your property was going to be reasonably priced, I think it would be something that I would try to convince my clients to consider. With that said, you're in a better position of putting your home on the market, if it's not already, and at least having it on the market when you make that offer, right? It's even better if it's in escrow. If it's in escrow, great. I mean, you can always put your home on the market with the idea that, hey, listen, I'm not going to sell it, a contingency on yours, unless I find a replacement property. So that way you've got yours protected while you're making offers on other property. And then it's a much stronger situation, a much stronger offer across the board. So that's how I would recommend you do it. Although I can't give you advice because you're under contract. It was 2 friends here talking. But that's if I were in that situation, that's how I would approach it. All right, Josh, a question for the audience, right? So that first part of the show takes about 15 to 18 minutes or so, give or take. Let's say 15 to 20 minutes. Do you feel, as somebody that shows up here, there's 85 of you or something watching at the moment, do you feel like that would be a better segment by itself where we just update you and then this show is strictly Q&A? So 2 separate things. That way it's not dragging in. Or do you like it as one? Let us know in the comments below. So comment 1 if you like it just like it is, and comment 2 if you think it would be better as 2 separate. How's that? Because I think we could actually even go to a deeper dive on some of this stuff if it were a separate show, because sometimes we cut it short. Sometimes we don't include charts because we feel like we're dragging it out and we want to give you guys the most bang for your buck. So
the early voters have spoken.
What did they say?
They one.
There
we
you
got
go.
no
They
twos.
like one. No twos.
If Mary's gave us 5 1s, 7 1s.
Okay.
Mary then follows up and says 5 1s and a 2. She can't even make up her mind. She wants both.
She wants it all. All right. Barry May says, is there a cap on insurance renewal for the California Fair Plan? So, I think at the moment, California insurance companies can't raise anything, right? I think that's part of a moratorium that was set with the fires recently. I think they have to keep insurance rates at the same for a year, I believe is what it was. If I remember correctly, as far as the FAIR plan goes, Josh, I don't know. Is there a cap? Can we ask Josh Bot?
Well, I'll give it a shot. I don't know how well it's going to answer. My initial off the top of the head, which is very unofficial, that no one should depend or rely on, is it's a subsidized interest rate or insurance rate. It doesn't cover their losses. It's saying, hey, can we collect some money while still keeping homeownership affordable for Californians? So I don't think there is a cap, other than our friends in Sacramento have to look at this and say, well, what's reasonable, that what doesn't, then it protects us from loss without crushing the housing market in areas where you have a hard time getting coverage.
All right, good stuff. Yeah, Josh, all ones, no twos. So I guess the show stays as is. I thought it would be a good segment for us to break off and just give people more of what they want, but it looks like
why don't we just do a walk and talk? We'll just take the Osmo and we'll just walk down Main Street to the beach, and whatever comes up, we'll talk about it, and then we'll throw it up once a week.
We could, but that's about a 3-mile walk, Josh. You know,
it's a good hour.
We could have a really long chat in that it's actually probably not a 3. It's not an hour walk, but yeah, we could do it. We could do it. Maybe we will. We'll see what happens.
Josh GPT says there is no fixed cap on California Fair Plan insurance premiums. It's designed as an insurer of last resort, typically due to being in high-risk fire areas. However, the premiums are regulated by the California Department of Insurance, which reviews and approves. Rates can go up, but increases must be justified and approved by the CDI.
Well, there you go. Good stuff. Right. Mary says, where are home prices dropping? I have not seen this in California. So I think the majority of markets aren't seeing dropping. Dropping is one of those kind of spicy words that are used to get clicks and what have you. But as far as, I say stabilizing more so than anything else, but I think the Southeast, Florida, I mean, Texas isn't Southeast, but I would say Texas, Louisiana, some of those markets are seeing more stabilization in prices, seeing prices go down compared to where they were, say, last year, because of insurance rates, because of HOA premiums, because of, taxes being adjusted for higher home sales, property taxes being adjusted for higher sales. So in those markets, it's more common, less of a concern here. Josh just threw a chart up on the screen where you can actually see those red little pockets there. Instead of being hot, those red little pockets are markets where you're actually seeing the biggest one-year change in home prices from January of last year to January of this year. So anywhere you see red is more of a drop, whereas, everything else is still seeing,
I think
any bluish is appreciation.
I think Lance had a terrible vacation in Punta Gorda because he always has Punta Gorda there as sort of the tip of the spear of bad stuff. But in looking at this, you can see the yellow stuff is primarily in the Gulf Coast states, but yellow's at 0, essentially flat. You got to get to the orange and definitely the red where you're seeing prices drop. So they're few and far between, but they're definitely out there. And we kind of talked about this today, Jeb, in the foreclosure episode. What has to happen? You have to have a weak economy, sometimes a weak economy with a natural disaster. Some of this stuff, if you look up in the North Carolina area that suffered from the hurricane last year, the Gulf Coast, Louisiana, we look at this, Louisiana doesn't have a strong economy relative to the states around it. So all of those things sort of come together that are impacting the weakness. So we talk about this. You need to know this data. You need to know this chart if you're in the market to buy, just so you're not looking at national numbers. I mean, these numbers are very, very different. If you're in Hartford, it's very different than looking at a condo in Punta Gorda.
Very good. Very good. So with that, Josh, that's the wrong layout. There we go.
I fixed it.
Fixed it. Not a lot of, I think that's really, we used to come in here and have, hundreds of questions, and
have we answered all of the questions? There's no more questions.
I think we've since backed off a little bit, just because is it affordability? Is it us? You just never know.
What I want to say here is G Money says One, the charts are fine. That's not the enthusiasm that we're looking for. What is it? I love the charts. I cannot live without them. Make sure you don't change anything was really what the hope was. The
No,
charts
the
are
charts aren't
fine.
going away. It was just, hey, would it be better served as a more not inclusive? I don't like that word. More of a an episode where we could go deeper on charts and data and that sort of thing, and then have this episode. I don't mind doing it all as one, but it's really just getting more content out there if that's what you guys want. So
We got a good question here, and you're
Yep.
going to start with it, and then I'll circle in at the end. Dave Gillen, what should I be looking out for when working with loan advisors or a mortgage team? So I generally like to think of it from the other way. What should I be looking for? What are the positives of things? But what should you be looking out for? I have one. I have one that a listener scheduled a call. I just got off the phone with her about an hour ago, but I'll share that after you share your thoughts, Jeb.
Looking out for. So if I were somebody out there at the moment and I were trying, I would look out for the person that is
How about this one? Someone telling you what you should do versus showing you. The question says loan advisors. You want a loan advisor. You want advice. You want them to guide you. But what I get a lot is, oh, I talked to someone and said, I don't want an FHA loan. So, okay, cool. Well, tell me a little bit more about your situation. And I'm hearing that FHA loan is the absolute right option for them. Like, well, why were they telling you? Well, it's because they got the upfront mortgage insurance premium. So, okay, well, the payment's about $400 lower a month for what you're looking at doing. Is that more important, or is it avoiding the 1.75 upfront mortgage insurance premium? So things like that. So that show, not tell. No one should be telling you anything. The other one, Jeb, that just happened, like I said, about an hour ago. It says, we're talking to two mortgage advisors. I think I decided who we're going to work with. She's only been listening to the show for about 2 or 3 weeks. Has been talking to the two of them for about a month, and says, the one is saying that they have some special incentives and they can give us like, $5,000 or $10,000 of credits that they have a special program for us. And like, there's no magic. No one has that kind of margin built into these transactions. So if someone is immediately telling you, I'm going to get you these credits, I'm not going to do this. If it feels like a sales pitch versus a conversation about you and your housing and your goals and where you want to go, it's a used car salesman that you're dealing with. And you probably have about an 80% chance of finding that person if you just pick up the phone and start calling.
Yeah, I would say talking to someone initially and then things, and then you going out and getting quotes from someone else potentially, and then all of a sudden they're better now. They can do better pricing, or that they've been able to adjust their fees to make something happen. Again, it's a sales tactic, right? It's like going into a car lot and then they show you the numbers and you're like, I don't like those numbers. Okay, well, let me go back and get you some new numbers. And then that happens. Like, that's a shitty way to do business to start with. Like, why wouldn't you just bring me the good numbers to begin with? Like, that's how you want to do business with someone. And there's too many people out there trying to make, in fact, there's a lot of loan officers that aren't doing any business, a lot of real estate agents as well. And people are counting on every single deal, right? And so, these people will do things in order to get business that aren't ethical, and you just got to watch out for it. I mean, I don't like saying don't go to the guy with no experience, but look up their NMLS license number and see how long they've been doing what they've been doing. And, you get a pretty good idea, right? I mean, you can have a conversation with people, ask the questions that you guys are asking on here, and see what kind of response you get. That's what you got to watch out for. I mean, it is a low barrier to entry business. It is a business where it's where times are booming, people come in. When it slows down, people get out because it's a sales job. It's not easy. It's not an easy business, but people are in here for a lot of people are in the business for the wrong reasons. So that's what I would watch out for. Josh, is this a question? This is not a question. This is a comment, I think. Oh, no. Explain to me. Explain to me. I'll wait for a buyer's market. Explain to me how all these home builder stocks are going down for the last 8 months. For example, Lennar been going down, but still in an uptrend monthly chart. So, Josh, explain that to outbid single moms. You explain it right now.
Uh, really, I've got zero interest in it. It's very volatile, very tied to interest rates. I wish I had the data here, and I meant to put a slide in. They do a survey every month of basically sentiment among home builders, and it was down this month pretty much across the board. They were feeling worse, but the interesting thing is, the poll was going on when Trump announced the Canada tariffs, which are big for home builders because of the softwood lumber, and those who had answered before he announced the tariffs had a 4-point higher estimate of where the sentiment was about the market, and those that answered after was 4 points lower. So there are a lot of things impacting what home builders are doing or thinking. What we're seeing, their margins are pressured, and we should all be so lucky to have margins pressured in the way that they have. Through the pandemic, they were at like 35% margins, $500,000 house, $150,000 of profit. And now they're having to give back, depending on where they are in the country and how solid the market is 5 to 10% of that. So they're only hitting about 20% margins. Still a pretty good business to be in. So if you're looking at a stock is a very different thing. We're looking at future cash flows. So maybe the market is looking at it going, hey, those cash flows aren't going to be as good in the future, but they're pretty good right now. And if you listen to all of their earnings calls, they're all pretty happy with where they're at. So, and also if we get another rundown like we did in August, so where were we at? Even as recent as the November 25th, the S&P Home Builders ETF was basically at a 1-year high. And then as interest rates have stayed lower, it just drifts lower. It's very interest rate sensitive because it is much easier and cheaper for them to sell homes when interest rates are lower. So if you think rates are going to go high, if you think somehow we're going to end up with a glut of homes, then maybe you should hold on and wait. You may be waiting longer than you think you're going to.
There you go. Delissa says, what are the major cons when getting 100% financing? This loan offers no PMI and no refi rate drop, higher interest rate. Is it best to put at least 3% down? Well, let's just answer the first part of the question. What are the major? You're going to have a higher rate when you're financing more. You have no equity in the property. Values go down. You're in a position where, you need to sell, something needs to happen. Again, you're in a position where you probably owe more than the home is worth. That could even happen putting 3% down if the market corrects. So it's not just 100% financing. You're just a higher risk for the bank when you're putting no money down. And chances are you're going to pay for that in some way, whether it's a higher rate, which translates to a higher monthly payment. In this case, you're saying this loan offers no PMI. So I'm not sure what loan we're doing 100% financing with no PMI other than VA loan, but Josh.
Well, Delisa, if you're still here, comment. Is this from a credit union? Who is offering it? There are a few credit unions that have off the wall programs like this where they loan their own money, and they say, hey, it's not much more secure for us with 3% than 0. So why don't we do it? They don't have to charge mortgage insurance. It says here that there's a higher interest rate. A no refi rate drop, anything that's sold into the secondary markets, which is like 99.9% of the loans, to get a lower rate, they can't just modify it. You have to do a refinance. So I'm thinking it is some type of regional portfolio lender. Let me play devil's advocate. You're not wrong, Jeb. You're 100% correct. Hey, you have less cushion in there. But if I put no money down and I get myself into a bad spot and I lose the house, what did I lose? I lost my credit. I didn't lose any money. Sure. So are you any more secure with 3% down, 3.5% down than 0%? No. So from that perspective, Doug Andrew wrote a book called Misfortune. His whole philosophy, which was formed he's a financial advisor. He lost a home in like 1980 when he's like 30 years old, his first home. And so he says, never going to do that again. I'm either going to pay cash for my homes where no one can take it away from me, which is also not true. You can have a tax foreclosure, or we're going to do 100% financing on it and just keep refinancing at 100%. And he came up with this idea when 100% financing was very available. And you're like, okay, I get it. I don't want any equity in my house where someone could ever strip it away from me. So there's a belief there. But yeah, Navy Federal Credit Union, I've never had someone take that loan program. But there's the pros and cons about it. So Navy Fed keeps that on their books. It's out there, it's available, has a higher payment, harder to qualify for. I don't really see some huge advantages to it. But if you did a side-by-side comparison, you look at it and you like it, I've seen it. I don't look at it and go, oh, that's a terrible program. You're putting yourself at risk. So hopefully that answers your question.
There you go. Not really. So earlier, Barry had a question. Are there any new guidelines coming up for FHA loans? Not that I'm aware of, right? I talk a lot about FHA on my channel. Any updates that come across will be updated. There's the potential for changes within HUD, and what changes could you possibly see? I think is a better question within the program itself.
Mortgage
I think
insurance.
probably mortgage insurance, right? Being
Yeah.
either less upfront, less monthly. That's where the real payment, the real change could happen. At the moment, we haven't seen it.
Jeb, let's throw some names out there so people that want to get upset and angry can get upset and angry.
Ooh,
Under
what are we doing?
Obama, we had a change to the FHA mortgage insurance where it used to be 11 years you had to have your mortgage insurance and then it automatically fell off. That's about the time that you amortize down to 75% of the loan amount. Well, coming out of the great financial crisis, which was not Obama's fault, some people think it is, they made a decision that the FHA mortgage insurance fund was underfunded by like 50%. It wasn't even close to what they needed in that because they were paying out so many claims on FHA foreclosures. So at that time, they raised mortgage insurance premiums. They made it permanent for the life of the loan. And you're like, okay, I don't like this idea, but there's some logic to it. It makes sense. Well, we are now 15, 16 years since he made that decision. And we've had 3 different presidents, Trump twice now, and no one has changed it. And we went from being 50% underfunded to 100% overfunded. So what I would bet is that sometime in the next 2 years, we will see the upfront mortgage insurance premium, that 1.75% that we were talking about that gets financed on top of your FHA loan. I would bet that comes down a good bit. And I bet they would take the mortgage insurance kind of back to where it is now. If you put 10% or more down, where it will go away after 11 years. I don't think that's
but
a
it's
big
probably
deal.
not going to be retroactive, just FYI.
Yeah, 100%. It's always with what were the guidelines with your case number when it was issued. So Jeb's 100% correct on that. But I think there's a very, very good chance because it's overdue. Someone should have done it sometime over the last 5, 6, 7 years. So I would bet we'll get it in the next year or two.
All right. Anthony says, what are your thoughts on demographics and the average age of a home? Seems like the majority of homes in my area were built in the 90s and haven't been updated. Could this affect sales in 10 to 20 years? I mean, I say no. We're in a market. Huntington Beach was built primarily in the 60s. A lot of homes.
Mine's a newer home built in 75. Was yours in the 60s or was yours early 70s?
I was 73.
Yeah.
So, I mean, yeah, there are people out there that want newer homes. The majority of the United States is not built newer homes. So, and those homes still sell. So I don't see it being a problem. Could some buyers want a newer home? Absolutely. But I don't think we're talking about much here. Scratchy Chance is, what do you guys think about the Doge dividends? I think it's dumb. I think if we're able to cut government spending, it should not go back to United States taxpayers. It should go against the deficit and get rid of the money. Like, what are we doing?
We've dug a giant hole. We have some dirt
like
we could throw back in the hole. Let's give the dirt away.
Yeah, let's not do that. Let's pay off. Let's go towards the national deficit, which I realize, let's be honest, it's not going to do anything. It doesn't do anything. But you put it in the hands of consumers, what does it do? Inflation, it's not free money. You're going to have to file it on your taxes. I mean, these are like, come on, guys. We've been through this. We did this a couple years ago. This is the same thing. It's all over again. It should go back to the government, in my opinion. Now,
only if the government promises to pay down the debt with it.
Exactly. Yes. It should go towards the debt. It shouldn't go anywhere else. That's what it's being cut. That's the whole idea of this program to begin with, is that, you're helping bring that deficit down. So I don't know. Anyway, let's see. We've got inflation incoming, so we will see. We will see with that. Let's see. Dan says the Q&A is the most valuable piece of the show for me as I get your insights on real world scenarios. So thanks for that, Dan. Opinions are always good, whether we like them or not. We do like to know what you guys are thinking, especially about the show. This is about you guys. It's not about Josh and I. It's really here to help facilitate the whole, educated home buyer idea. So,
and hey, Jeff, while we're talking about it, I actually had a conversation with a listener this last week, and they called after they got a property under contract, and he is talking to 2 different lenders, and so here in California. And I asked, well, why didn't you call us? And he said, well, I did. I'm kind of embarrassed. I had scheduled a call and I got scared and I canceled it. So I promise I don't bite.
Scared of what?
Scared of what? I mean, you are going to talk to me, and we're going to go through it, and we're going to talk about you and your situation. We can't do that. We can answer your question here on the show, but if you reach out, you fill out that form. I cover about 20 of the states of the 50, but that covers about 87, 88% of you that inquire. So there's about a 9 in 10 chance that you and I are going to talk, and we're going to go through your situation. Some people aren't ready. They're early, but we're going to go through and get you that side-by-side comparison so that you know what your options are, what the numbers look like, and you can make educated decisions. If you don't have those, and it's shocking how many people that I talk to, well, I'm talking to these two people, I don't really love either one. Like, why did we not keep talking? Why did you not reach out? Why did you watch the show forever and not give us a call? So if you're thinking that you want to buy today, next week, 6 months from now, a year from now, and you have questions and you're not clear on what you should be doing or where you should be looking to maximize your chances, schedule a call.
There you go. Well said, Josh. And you can do that using the referral link, jebsmith.net/start. So, Mr. Josh, we are at that point again where we're just talking to one another. So, let's talk a minute here about HOAs. Get a lot of questions on HOAs. And the reason I want to talk about HOAs is because I want to stand on my little soapbox here and bitch for a moment about HOAs. I've got a client selling a property in here locally, and when he closed on the property, the third floor was carpet. It was a tri-level property. It's actually considered a condo. It looks more like a townhome, but it's considered a condo. Attached wall on one side. He's an in unit, so only one attached wall. And so going through the sale of the property, it comes back like a week before closing that there's an HOA violation, that he didn't get approval for the flooring in the property. And so a couple of things. First off, the only way they know that is that they saw the pictures online or somebody ratted it out, right? He's been living in the property for 2 years. The neighbor hasn't complained about, the flooring. But better yet, when he closed on the property, he reached out to the builder who built these. They were new construction, and said, hey, can you provide to me the same flooring manufacturer, the same color flooring, everything that you put in the first 2 levels of the property, because I want to put in the third, including the padding, including all of that. That's what he installed. So now we're fighting with the HOA to get this thing closed, which is supposed to close yesterday, but we're having to push it out because we're waiting for the HOA to give us an approval of something that they essentially allow, but just because my client didn't go through the proper channel to get it done, we're now under their bureaucracy, if you will. And it's like these people won't talk to you. They'll only communicate via email and via mail and whatever else. So if you're buying in an HOA, be careful, right? I live in an HOA. I'm cool with an HOA, but just know what you're getting into. Sometimes it can be a complete pain. And this is one of those times. So you guys often ask about HOAs. You ask about stories. This is one of those stories that read the fine print, right? He wasn't even aware that he needed to get approval for the flooring, and come to find out, supposedly he did. So anyway,
it's kind of shocking to think that they would put in here, hey, we need to control what you do to the interior of your unit. The logic I don't get.
I understand it if somebody is above you or somebody is below you, right? If hardwood floors occasionally if you don't have the proper sound barrier, some of these condos, like there's another community here in Huntington Beach, Seabridge, that you can't put hardwood flooring in any floor but the ground level because you can hear it there, regardless of what the soundproofing looks like. The properties weren't built for that. And that's a different situation. You got somebody above you. This is somebody beside you. I mean, the flooring isn't going to matter. You should see the insulation in this place in the attic. I've never seen a property, Josh, maybe you've seen this, where you go into the attic of the property, because I went up there with the homeowner to look at something that was in the home inspection report, and they sprayed the entire attic with that foam that you spray in, like the big bubbly stuff. But so you can't see, like, you can see the undersheeting of the roof and all that. Yeah. Dude, it's just like this big ass like bubble, like the entire roof, the inside of this house. The insulation's crazy. So I'm like, there's no way you can hear anything if they did the insulation like this in the walls. But anyway, stepping off the soapbox now, Josh, and going to questions if we have any. We don't. So is this the end of the show?
It's the end of the show. No one has questions. This is the first time in what, almost 3 years, 3.5 years we've been doing the show that you guys have run out of questions. I'm a little disappointed. Maybe we've just done such a good job of answering all of the questions. But hey, Jeb, Christine Mindo here asking questions. She showed up at the webinar. She educated herself. I've been talking to her. She's looking about making a move, getting out of the cold Chicago winters and going to the warm sun of Texas. But she's got a question. Would you ever recommend opting out of rolling homeowners insurance and property taxes in with the mortgage payment? Why did this become standard practice? Jeb's going to answer the first question, but let me throw in the second. Standard practice because lenders want to know that the property is insured and you're not falling behind on your taxes. They can monitor it. They're going to make sure you have insurance, whether it's included in the monthly payment or not. It's just additional security for them when they're in charge of it. But Mr. Jeb, do you have impounds? Would you ever recommend not having impounds? Well, how does all that shake out for you?
I do have impounds. I guess the better question is why not have them? You wouldn't have them if you can invest your money and make money off of it in that period of time, right? I mean, that's the only reason not to. You want to control your own funds. You don't want the escrow company holding it, or the mortgage company holding that money. I'd rather it just go. I don't like seeing one large. I don't like seeing the tax bill come and think that I have to just come up with that money out of my pocket. I like paying it every month, and it works well for me. So I see both sides depending on where you are and how you handle your finances. But most people don't budget. I don't really have a strict budget. Some people are really good at budgeting. It's one of those things that I'd rather just not worry about it.
Let's use Christine's proposed new home state as Texas. Texas is 2% plus or minus on your property tax. Buy a $500,000 house, it's $10,000 a year taxes. They're due once a year. Would you like someone to show up and knock on your door once a year and say, I would like $10,000? I don't want that. I know that it is no different if I give them $850 a month than if I give them $10,000 at the end of the year. But for me, when we bought our first house in the late 90s, we had impounds. And then we moved and I'm like, I don't want, this house is twice as expensive. I don't want them having all that money. And then we refinanced about a year later and I was like, that was a pain in the butt. I don't want to remember twice a year to have to write this big check. So we impounded. I impound every property I have. I'm going to say 97% of it's not 98, 99, but it's more than 95% of our borrowers choose to have them impounded for those same reasons. You'll get the rare person that it's also generally the person that rotates their credit card balances around to keep a zero balance everywhere they go and is willing to jump through hoops to save 4 nickels. That person is the one who's drawn to keeping that money under their control because they got to plan for it at all times.
All right, good stuff. Sounds like Josh is in the same community where I'm selling this other property. Says outdoor second patio useless. Touch it, the HOA will come after you. Yeah, I mean that's common in a lot of communities out there like that have, the problem with boards, here's the thing, is most people are on the board. Well, I can't say that. That would be a big assumption. People aren't reasonable. They don't have any sort of middle ground in sort of this thing. I've been on a board for a number of years. I was on a board for 4 years. And it's all about negotiation. It isn't about like, hey, I'm always right and everybody else is always wrong. It's about, hey, these are the rules, but can we see some middle ground in these rules where we can, work with the homeowner and also not set a precedent that that's okay, but we'll still work with it over here. That's the right way to do this versus somebody having a power trip. And in my community, there's people walking around all the time looking for problems. It's like, come on, like if a problem comes up, address it. Don't go out searching for issues. And that's the problem with a lot of these things is you get people that are bored, they're retired, they're looking for things to do.
Retirees are the problem. They are the entire problem.
But not every HOA is like that. Most are not, but there are some that are. Jay Homeboy says, Josh, if I go on that rate watch list, if rates don't drop for 2 years, am I still on that list?
You are on there forever. until you tell me I don't want to be on that list. Then I'll probably still leave you on the list. I just won't tell you when the list tells me you have an opportunity, just out of spite for you not wanting to be on the list any longer. Our clients, if you close a loan with us, it's automatically added into that list. I get an email, like not right now because rates are elevated, but when rates dip, I'm getting an email a day. Hey, this triggered, this triggered, this triggered. So we are able to add people to that list versus just the ones that we closed loans for. So we get your mortgage statement, add you on there. And if it never triggers, it never triggers. But the moment it does, I'm going to get an email and we're going to call or email you and say, hey, we've got an opportunity. Let's run through the numbers. And we've had a couple of people here recently. We run through the numbers and like, yeah, we could justify it, but why don't we hold off and see what happens over the next 3, 4, 5 months and see if the Trump dividend gets rates down lower.
Delissa, another question says, are there any issues that are already common issues rather that are missed during inspection? Should we explicitly ask for certain things to be checked? No, I don't think there's any common things. Just find a good inspector, somebody that's thorough, that's been doing. That's what you want, right? You probably don't want the new person coming, being your home inspector, you being the first inspection. Just find somebody that's detailed, but you don't want somebody so detailed that they create problems that aren't problems, right? There are inspectors out there that think they have to mention things and give guidance on things where they're not, they're not the expert in those things. They're there to report problems, potential problems in some cases, cosmetic issues, that sort of thing, but they're not there to tell you how to resolve them or in some cases how to be resolved. So just find somebody that's good at their job. And if you're working with a seasoned professional real estate agent, they should have somebody that they can at least give you some sort of basis to start with, and then you can kind of do your research and use them as an option if you can't find the right person for you. So Josh, we got Scratchy saying they're trying to buy a new build this year, but they're okay waiting for another year. I do see another builder dropping their base price. Do you think other builders will follow soon? So this is kind of that question, Josh, that we've had. Too hard to say, right? If you're in a market that has a ton of new construction, properties aren't selling, builders aren't in the business of holding on to property, right? Rarely ever will you see a price drop on a property. But what you will see is incentives for upgrades, incentives for rate buy downs, incentives to do other things because the builder doesn't want to shoot. Could it happen? Sure. But what I will say at the moment, most markets out there are still relatively strong. Builders aren't building a ton of spec homes, right? Most of what they're building is, allocated as it's being built. A lot of these communities, other states I know are different. There's probably some in Texas and some of these other areas that, homes are sitting on the market, but I don't think that's the general, the overall market. So hard to say.
I would say it goes, Jeb, it's supply and demand. So you said that right away. How much new construction is there in your area? If you're in an area where there's very little, I wouldn't count on it changing. If you're in an area where there's a lot of land and these builders, it's not like you can, they can build less to protect their prices, but if that's your business and the way you make more money is building more houses, they're having to balance that. So like Jeb said, the price reductions are less likely than throwing in sweeteners to make the same price more palatable to you.
Splenda.
A little Splenda, but know your market, because it's definitely your mileage may vary. And going back to, we talked earlier about the home builder stocks, listen to their earnings calls. If you're looking at big builders and they're not local builders, they're going to tell you, because they are telling you that it's region by region. The same builder isn't offering the same incentives everywhere around the country. They know where they have to sweeten the deal more and where they're like, hey, we don't have to give you anything. We're going to be able to sell this house.
There you go. Night Panda, another regular, says, when buying a new home while already owning a home, do you need to prove to the lender that you are able to rent your existing home out? Do the lenders calculate two mortgages against your adjusted gross income? So Josh, how does a lender look at your current property if you're buying another?
It's a departing residence, and if we want to use that to offset your payments, you are going to have to be able to show a lease. So I've got a buyer doing it right now here in Palmdale, Lancaster area. They're moving out of one house, buying a bigger, nicer, newer house, and we had to get a lease to show that they have the rent's coming in. And we're going to have to get a market rent survey most of the time to confirm that that is a reasonable rent. We can't just say, I'm going to get $24,000 a month. So from that perspective, and then let's follow up the second question: do the lenders calculate 2 mortgages against you? If you can qualify with 2 of them, then we don't worry about any of that. Sometimes we have people that are really well qualified, buying well under their means, and we just say, I hit you with both payments, you're good. I've got one of those right now. Not an issue at all. It's actually Caesar, who was on the show 2 weeks ago and asked, we have his we're hitting him with both payments on his, and he's absolutely fine.
I'm posting this question primarily to talk about Phoenix. So Scratchy says, I'm building from the ground up and they are offering good incentives. I'm in Phoenix. So the reason I'm bringing this up is because I spoke to John Angelo today. John Angelo, Josh knows, he is a realtor buddy of mine who works the Phoenix area, great real estate agent if you're looking in that market. We check in regularly just to kind of see what's going on in markets or what have you. And so I asked him what was going on in Scottsdale, or Phoenix rather. And he said, you know, under 500, still moving pretty well. Above 2 million, hot, like insanely hot. But he said anything in between 500 and like 1.5, 1.8 is slow. And I was like, that doesn't make any sense. Like how this middle price point? And he goes, those are typically the people in our market that are getting loans. He goes 500, some of it's investor money. You know, it's cash above 2 million, whatever. It's a lot of cash buyers, a lot of people with money. The people that are getting financing are kind of in that middle price point there, that not a middle, but in our conversation here, the middle. And he said those people are being affected because of higher rates, affordability, all of those different things. And so that market is slower. So I just thought that was interesting information to throw out there. So if you're somebody that is in that market and you're in that price point, probably a little bit more, you know, sellers are willing to work with you, a little bit more of a buyer's market. Price reductions are routine. You're going to see more of that in that market. So anyway, just some side notes. Night Panda with a super chat of $10. So thank you for that. Dinero.
I think, you know, just different markets, different things, new construction, existing. Like the biggest thing is, if you're serious about this, this is one of the biggest investments and one of the biggest debts you're ever going to take on. Do your research even before, like just
Don't tell me. I might buy a Bugatti, bro.
Yeah. You need to know they're getting like $2 million for like 4-year used ones. And like, what are we talking about? These people are crazy. And you know that if you misplace your key, it's $15,000. You get a new key for it. You're not getting.
Bro, if you got $1 million car, $15,000.
If someone tells me I'm paying them $15,000 for a key, someone's getting a key shoved in their ear.
Bro, if you have that kind of money to own a car, somebody should carry your key around for you. Hey, you hold my key.
Well, the funny thing is, I saw a video here on YouTube. Is a used car dealer. That was his goal. He wanted to have a Bugatti. He sold like 5 different cars that he had, bought himself one. And this one was formerly owned by a rapper. And the key, it's actually the speed key that you have to put in to unlock the 220 miles an hour or whatever it can go. The guy had made it into a necklace and he was still wearing it, even though he hadn't had the car for 2 or 3 years. They had to track the guy down to get the $15,000 speed key from him.
That's hilarious. Good story, though. All right. Did we answer that? Well, no, this is a comment from Miguel. Says, thanks for the consistent content, gentlemen. We're gentlemen, Josh. That's great.
I like it.
Your videos last year helped educate me to get a $400,000 new build outside of Dallas at 5.875%. So congratulations to you. We are just the facilitators of information. We're not the actual doers. You did the work. So congrats to you for making that happen.
Just so you guys know, I'm going to be so tickled when we get back to whatever is a normal market.
Tickled.
I will be tickled when we get back to a more normal market, because builders, They like making money and nickel and diming you every 6 ways to Sunday. So giving you 5, 10, 15, $20,000 for your loan and buying the rate down, it's like 100. It's like your stingy uncle who never gave you a gift coming over and giving you the greatest Christmas gift ever. Because it used to be someone would say, hey, I'm buying new construction. They're making me pre-approve with their lender. I said, awesome. After they insult you with their terrible offer, call me up and we're going to look amazing. And now you're like, we don't even need to talk. I'll help you quantify how their $18,000 is really $11,000. But anyway, you cut it. You can't turn the deals down they're offering right now.
It's the same thing as a real estate agent. When times are great for them, they don't want to pay agents. When times suck, guess what? Buyer compensation's through the roof. They're willing to pay you whatever in order to get buyers in the door. So it's the greed. They need you when they need you, and they don't when they don't. And it's the cycle. But it will come. It will come. It's just a matter of time. Josh, we've been on just under an hour. We got a couple minutes for some more questions if they come in. But in the meantime, if you're in the market, you haven't reached out to Josh and the team, make sure you're doing that to get pre-qualified. If you need help with real estate agent, happy to help you facilitate that. Last year, I don't know how many people we helped out of state, but quite a few. Well, actually, even in California. So connecting you with people all over the place. So if you need somebody, make sure you're reaching out and we're getting you connected. So Johnny says, what do you guys think of Phelan, California market? I don't even know where that is, Josh.
It's it makes Victorville look close in. So it's like keep going, like Yucca Valley way out there.
All right. So what do you think of that market, Josh?
I'm not the right one to ask. It's so not me. The further you get out, like you can tell me there's a certain buyer for Victorville and that it makes sense for. I have people that are from LA and they go, hey, I love that beautiful big house at an affordable price in Victorville. And they're telling me they're going to continue working in LA. And I go, you are not a Victorville person. But if you're a guy who works construction in Riverside and you want to spend your weekends in Havasu, Victorville can make all of the sense in the world. So I'm sure there's a person for Phelan, just like Yucca Valley, where they're desert people. They like it where it's hot. They like some land. It's just not me, and I haven't followed it. I'm sure you're not asking, hey, does Josh personally want to buy a house in Phelan? It's just because of that, I don't look at it super closely. The further you get out, we've talked about this before, Jeb, the further you get out, the last they are to participate in prices going up. And so Phelan and Yucca Valley and Joshua Tree have been booming over the last couple of years. But if we ever do hit a soft point and prices start coming down, they will be the first areas to come down. So a little more risk there, definitely more affordable. If you like it, do your research. Before I told you, hey, jump in, I would want to do some additional research, but there's nothing about it that I hate. Since you don't know where Phelan is, or
well, Josh, yeah, I mean, since I couldn't even pronounce it, I'm probably not the guy to ask. So we'll just move on to the next question. Marcus, we answered this one earlier, but Marcus says, if upfront mortgage insurance is reduced in the future, will that be retroactive to loans processed now? And the answer is probably not. High likelihood it's not.
The upfront, again, absolutely not, because upfront is
that's already financed.
You are never getting that money back.
Yeah.
But
even the monthly, right? It's tied to your FHA case number. And so in order to get that reduced, you got to get a new case number. And this is the way it's worked in the past, right? None of these changes have been retroactive to everyone. It's only been to those who have, refinanced. In fact, there are people out there with FHA loans from before 2011, 2012, Josh, whenever the year when it changed that,
and they're still
their mortgage insurance will still fall off. I mean, at this point it should have anyway, but there are people out there that have them previous that didn't get the change when that updated. So anyway, if Josh and I can be of assistance to you, there's a link scrolling the bottom of the screen. We appreciate you watching. We'll be back next Wednesday with another episode here live. Until then, adios,
amigos.